Let's get in Rajesh Baheti, MD, Crosseas Capital Services. Thank you so much for joining us, Mr. Baheti. I just want to start off with the IT space. Now, I know that you don't want to talk about individual stocks, but I'm just taking TCS as an example because, you know, one of the things that had caused TCS to take a bit of beating after Brexit is because it was seen as one of the more UK and Europe-oriented exposed IT players. But now it's talking about the US, and that affects everyone.
Absolutely. Let's look at the structure of the IT industry. You know, the raw material sourcing is all from India, which are the people of this country. Now, India is still showing a growth rate of 7%, and we still have inflation in the range of 5%. So you have to have salary increases maybe to the extent of 10-12% every year. On the other side, you have the global markets where the IT firms have their revenue coming from, where growth is anemic, non-present in Europe, very, just recovering in the US, a lot of substitution happening, a lot of, new technologies coming through. So they don't have the pricing power or the growth coming from those markets. So the IT industry gets sandwiched between raw material sourcing where you have inflation and the final product where you have deflationary conditions and anemic growth. At the same time, the rupee, which used to save them, every year by depreciating steadily, has actually appreciated over the last 2-3 years. If you look at 68, 69 that we hit in 2013, and now we are ending 2016 and we are at 66.5. So that has not helped. So, structurally, they are now going to become what you call utility plays at best till such time as you see growth. And for utility plays, you have to have dividend yields close to 4 to 6%. And these stocks are still nowhere showing you a dividend yield of that kind. So the story is, very, very clear that these stocks will continue to be under severe pressure for the near future.
So again, this is a question that I've been trying to get views on for the last 1 month, and that is the structural change that you're talking about and everyone is talking about in the IT space, that the cost arbitrage is probably going to disappear because a human being is probably going to be replaced by an app or an artificial intelligence, and therefore it no longer matters where you're supplying the service from. That affects the IT space. But if I take an Infosys, again, if I look at the kind of cash it has on its books, that is approximately 120 rupees per share. Now, with that kind of cash, as you mentioned, that these are going to become utility plays, and let's say with an 8 to 10% growth in bottom line every year, or let's say even a 7 to 8% growth bottom line every year, is the only way they can actually continue to maintain ROEs or ROCEs is essentially by returning cash, buybacks, giving higher dividend, and therefore one can actually buy these at these levels?
Yes, absolutely. There is no justification for holding on to such cash levels when there's no point, when they're not deploying them. And I think shareholders ought to be, asking these questions to these IT companies that why aren't you distributing more cash back to the shareholders? Buybacks don't make sense because the dividend yield is not attractive enough. Right. So I don't think it will be beneficial for the minority shareholders to have buybacks at these prices. But certainly, getting the dividend yields close to 4 to 5% for these companies makes sense. So the P's will continue to shrink, and unless the dividend yields become attractive enough, I don't think you'll see buying from value investors at this stage. So pertinent question, why are these companies not distributing cash back to the shareholders?
I mean, one more thing that a lot of investors would probably fear is that they have the cash, they might go and do an acquisition just to show that we are doing something. And given the kind of valuations that any of these new age tech companies have, they'll probably pay more than that those companies actually deserve, right? So there is that fear as well.
Yes, of course. You only hold on to cash if you find acquisition opportunities, and sometimes what happens is you fall into the trap that you have all this cash, you're not giving it back to the shareholders. So by default, that means you've got to deploy it somewhere. And we know how valuations, frenzies affect people's minds, their thinking, clarity of thought, and people do get sucked into valuation theories. And it's happened in the past, it will continue to happen. So the question is again, if everything else that is disruptive is looking very, very expensive, and you don't see growth opportunities in the near future, this cash should ideally be returned back to the shareholders.
Okay, let's say you, and this is where I would get your view. Obviously, you're saying that avoid getting into this. But suppose I bought something like a TCS or an Infosys 2 years ago. Then I am in a bit of a bind, right? Because my returns can, if I get out now, then I can probably protect some of my returns. But if I continue to hold on, I'll probably see my valuation going down even further. So will you say that if you hold an IT stock right now, sell it?
Yes, in an honest opinion, yes, they might be close to their 52-week lows, but we've seen that doesn't help the market much. The markets are outpacing the IT companies. The market has gone somewhere else. The IT group has gone somewhere else. Clearly, people are divesting their portfolios, otherwise they wouldn't be where they are.
Right.
And they're still not cheap enough for you to consider them as steady income stocks. So they're not even income stocks, they're not even growth stocks. What do you do with them?
Right. Okay. All right. Let me move out of this IT space and go into PSU banks. Now, about I would say 2 weeks ago, I think on this channel you told us that it's time now to book profits on PSU banks. Some of those PSU banks have suddenly shown some sort of spurt. Some kind of buying appears to have come into those banks. Are you changing your view, or are you saying that this is just a dead cat bounce, stay out of it?
Yeah, so one of the reasons could be, that the government has decided, the infrastructure companies where you had a lot of these arbitration proceedings that were pending or held back, some of the cash might come into these companies, and eventually they will find their way into the PSU banks. So maybe, the new round of optimism stems from that. But I continue to hold my view that now you've got to be very, very careful. Market has raced on from, the last time we spoke, we were at 8,600 levels, we're at 8,900 levels. So sector rotation takes place. I think the private sector banks, some of the overpriced stocks in that had become far too overpriced. And so certainly, relatively something appears cheap, but that doesn't mean that it's cheap on an absolute basis. So relatively, the PSU banks are very, very cheap, but on an absolute level, given the kind of stress they have, I think it's time to book some profits.
So you will reiterate your call, because if someone's not seen you I think you appeared on the 22nd of August, and it's been about 2 weeks since then. If they've not heard Rajesh Baheti, it's still, you're saying that if you've got those additional 5-6% gains, book it, get out right now.
Yeah, but I kind of also said that get into these stocks at the beginning of March when they were, was 70-80% below these levels.
Yeah.
So,
so you're saying that if
you can continue to be fooled by the market, because the market continues to go up.
No, but if you had, let's say, you were part of this buying streak in the last 14 days, what do you do? Should you book profit even now if you just entered it, or should you hold on?
Honestly speaking, just look at the market today. You've had in the last 24 to 48 hours, primary issue announcements to the tune of 15,000 crores. You have the L&T Infotech IPO, the ICICI Pru, you have the QIP from Yes Bank. Yeah. You add all that up, is 14,000 crores. When was the last time we had something that big? That was when the Reliance Power IPO came out.
Yeah.
And what happened to the markets after that? So we are building up to this, the end game in the near term for the bull run. And when that happens, you'll see serious reaction to the tune of 15-20% in some of these high beta stocks. And PSU banks are high beta, and so which is the reason I say continue to book profits in these. It doesn't matter when you got into them, but I think it's a good time to take an exit. At the same time, I maintained last time that you've got to now separate the good PSU banks from the bad ones. You made money in almost everything, at least sell out of all the PSU banks where you don't see management quality.
Right. Let me then move away, because you're saying that this is the beginning of the end game. And do you mean it only for PSU banks, or you think that the Nifty itself or the Sensex, it's the beginning of the end game of this leg of the bull run?
Yes, that's what I think. It's the beginning of the end of this leg of the bull run. So, of course, this can stretch for the next 2, 3, 4 weeks. That's anybody's guess. But if the Nifty and the Sensex were to react, let's say, by 5 to 8% from here, I think the PSU banks would be reacting by 15 to 20% because of the beta.
Okay, so 5 to 8% is about 400 to 600 points from here, which means that you're saying that we go down to 8,300 kind of levels, right? 83, 8,400.
It's entirely possible, if the global scenario changes, it's not something that's unthinkable. It looks unthinkable today, but it could very well happen.
Okay, I just want to, I know you you don't want to be stock specific, especially in this kind of a market, but I just want to revisit a call that you gave us about Vedanta and Cairn. And you said that go long with Cairn, go short on Vedanta, because if this merger doesn't come through, then Cairn gains. Then how have you changed the view now, and what should investors do?
Well, so at that time, Cairn and Vedanta were trading at the same price. So Cairn has gone to a 25 to 27 point premium over Vedanta. But there's a question that, is disturbing about this whole merger process, how valuations are arrived at. If you look at the initial valuation announcement, the management of Vedanta justified the valuation of 1:1 with one preference share. And that was at a time when Cairn's business matrix was actually better than what it is today. The oil prices were higher than what they are today. Now the Cairn's business matrix has actually deteriorated. Oil prices are 20% below when they first announced that merger. And yet, for some reason, the management has thought it fit to add 3 preference shares to the valuation. So are we talking about managements dictating valuations and then accountants finding a way to justify them, or valuations being discovered by accountants and managements bringing them back to the shareholders? So I think there's a serious corporate governance question that needs to be asked on this.
So by that logic, one should sell both the counters, right? And get out of it. If there are corporate governance issues, would you say that that is what one should do? Oh, sorry. I'm asking you a...
I would think so, yes.
Okay, all right, great. So, is it fair for us to then, we have this kind of a stamp where we put it on the stock based on our experts' view. Is it okay if we put that sell stamp on Vedanta and Cairn? I know you didn't want to be stock specific, but I asked you a stock specific question. Is it okay if we do that?
No, I'm not just comfortable with the way they've gone about this thing. They've sweetened the offer, and they've not offered any logical explanation why the valuations of the two companies have changed. Because if they were very confident about the valuation reports, which said one share and one preference share, then they should have held on to that, whether the merger happens or not. So clearly we know that the only reason for this merger is because Vedanta can't afford to return the cash they've taken from Cairn India. And that's very, very clear.
So that would mean a sell on both the counters.
I'm not saying buying or sell, valuations
all right. Okay,
can
that's
go
fair.
anywhere,
That's
but there are
absolutely
corporate
fair.
governance questions that we need to ask.
Absolutely fair. Thank you so much, Rajesh Baheti. You did not give any specific recommendations, so I'm not going to ask for any disclosures. Thanks a lot for joining us. Pleasure talking to you.